What's going on, everybody? It's Stas here. So in this video, we're going to be breaking down 3 dividend stocks that I'm buying right now in the stock market that are actually under $50 per share. And I want to dive deeper into these companies, break down some metrics involved with their dividends, and in general, talk about why I'm long these companies, despite some of them here being under some pressure. So if you guys find value, hit that like button for me, consider subscribing to the channel, and check out all the free links down below in the description box if you want to join our Discord chat, our Facebook group, and if you want one free stock from Webull valued up to $1,600 with a deposit of $100, that is also linked down below in the description box. So stock number 1 is right here on the screen, and we're also going to be breaking down some technicals in this video as well. And stock number 1 is AT&T, ticker symbol T. And right off the bat, we can see the stock's gone from $39.50 back in the beginning of 2020 down to $26 in the pits of the crisis, and it hasn't really recovered from there. It's only hit $26 and come back to about $29. So a $3 recovery in AT&T, while other stocks out there, tech stocks mostly, and a bunch of other ones as well, have been recovering like crazy. So the question is, why is AT&T slacking here? There's a lot of things that people could attribute that to, right? One of them is they have a lot of debt, a lot of debt, long-term debt here, and they've made some pretty poor acquisitions in the past that are really hurting the business right now. And for me, guys, and right off the bat, you're saying, Stas, you're saying all these negative things about the company, but why are you buying it? Well, for me, I like buying into companies when they're weak because I think they can rebound, right? That's the whole ideology behind it. Yeah, AT&T's made some poor acquisitions. I think they're a bit weak right now, but with their debt repayment and them digging out of the hole and looking into the future with some of these segments we're going to talk about here in a second, I think they're poised to bounce back, right? So I'm looking at this as a bounce back play that also pays a nice dividend, right? Which is why I'm buying it right now. And let's get deeper into that. So in September of, actually, I don't even know if it was September, but in 2015 in general, they spent $49 billion, guys. So almost $50 billion on DirecTV and another $85 billion for Time Warner in 2018. So massive acquisitions there, 2015 and 2018, and that left AT&T with a net debt of $180 billion, and the company, like I said before, has been viciously working to pay that off since then, right? And especially these past 2 years, they've been working very heavily to pay that debt off, right? Despite there still being a lot of debt, right? But they're working at it. That's what I like. And DirecTV, along with other television offerings in AT&T, this is actually a detrimental thing about the company. They've been losing subscribers pretty much quarter after quarter for some time right now. They lost 4 million subscribers in 2019 and another 1 million subscribers in the first quarter of 2020. And why is this? Well, because people are cutting their cable. They're moving from traditional TV and they're going to streaming services, Netflix, all these new ones, Disney Plus, Hulu, whatever. And AT&T is actually working now on streaming services. Warner Media segment introduced a new streaming service for its HBO television network called HBO Max back in May. So they are trying to position themselves with streaming services here for the future. Obviously, their traditional telecommunication business is massive. That's still doing pretty well. And with the rollout of 5G here, a lot of people are speculating a lot of new phones are going to be coming in. Obviously, AT&T is involved with that. So this is some good things coming from the business as well as some negative things, right? So weakness overall here in AT&T, down about $12 per share from its peak, $11, $12 here on the 4-hour chart. But like I said, I think we can move forward. I think AT&T is positioning itself nicely for the future with actually now trying to sell DirecTV. I was reading they're trying to sell DirecTV right now for about $20 billion. That's speculation. I don't know if that's going to happen 100%, but they're trying to get rid of this bad acquisition, take the loss there, and move forward. So that's pretty good for AT&T, and their dividend at this point in time, which is why I'm in it, honestly, so I can get the dividend and that price appreciation moving forward, right? The dividend is the main reason why I like this company right now. Their dividend is 7%, and they have a $2.08 annual payout, a 65% payout ratio, a 2% 5-year compounded annual growth rate, which isn't the best. It's not growing the dividend at clips such as, let's say, Microsoft or Apple, right, which they grow it very quickly. So their AT&T is growing it a bit slower, but it doesn't matter because for me, the current yield of 7% is nice, right? And they've had 25 years of dividend growth at this point. So they're a dividend aristocrat, which is also nice. And for me, guys, the dividend is looking pretty safe as long as they continue growing the segments of the business that are growing and they get rid of the bad businesses like DirecTV and so many other little, nuances in the business. I think AT&T is moving forward. So that is stock number 1, and I really do like this company as a dividend play. So stock number 2 here is Altria, ticker symbol MO, and this is very similar to AT&T in the sense that it's gotten hit pretty hard and it hasn't recovered that much, right? It's gone from $52 back in the beginning of 2020. It dropped to about $31 in the pits of the crisis, and from $31, yeah, it's recovered a bit more than AT&T, up to $43. That's a recovery of about 25%, but it hasn't fully recovered quite yet. And going back to AT&T, they've only recovered, because I don't think I mentioned this before, they've only recovered about 7%, from where it was in the crisis, worst parts of the crisis, to where it is now. So AT&T really hasn't recovered, and Altria really hasn't recovered too much in the grand scheme of things, although it has recovered more than AT&T. Either way, like I said earlier, both of these businesses, AT&T's facing its own issues, and so is Altria. Altria had the Juul acquisition completely blow up in their face. It didn't work out. It did not work out. They lost billions of dollars there, and the stock is still cruising along. The stock's still cruising along, but that put a dent into their pockets. Let's be honest. That put a dent into their pockets, but despite that, I think Altria is still able to move on. I think with their tobacco products, with traditional cigarettes, they have investments in alcohol, they have investments in MJ, they have smokeless tobacco. I think it's called IQOS. It's a heating pad you put on your arm, your leg, whatever. So they have these different segments of their business, and despite Juul blowing up in their face, I think they're moving in the right direction. Sure, their traditional products, cigarettes, right, those are declining. The sales are declining. Less people are smoking. We know that. The statistics are there. The data is there. But what Altria has is pricing power, right? So they can inch up the price of the cigarettes as people stop using them, so they're not losing money. Quite honestly, their EPS, from my memory, has been going up, and their revenue is pretty stagnant, but it has been creeping up as well. So one thing that Altria has, again, is pricing power, and if you think MJ, which you guys know what MJ is, and they have an investment in Kronos here, and if you think MJ is going to blow up and be a worldwide thing, which I do, I think it is, Altria, with all their relationships, their distribution networks, I think Altria is in a very good position to get a lot of product out there through all the distribution networks and so forth. So for me, I think the risk reward is there with Altria. And another thing, guys, tobacco stocks have always been viewed as defensive investments. Pretty boring, safe dividend, nice cash flow. And speaking of the dividend, right, It's almost 8%, almost 8% right now. They have an annual payout of $3.44 roughly, an 80% payout ratio, so not too bad there. I mean, it's a little high, but like I said, these companies traditionally pay a lot of their earnings in dividends because they're boring, just cash flow churning type businesses. They want to pay a lot back to their shareholders, and they have a 5-year compounded annual growth rate of around 5%. And their dividend it's been growing for 50 plus years at this point, which is pretty impressive. So that puts them in the dividend king category, right? Growing 50 plus years in a row. So they are experiencing some difficulties with Juul, the dent in their wallet, and so forth. But I think Altria is a pretty safe dividend company moving forward. And yeah, there are risks of regulation, whatever, but there's risks with regulation in many businesses. And for me, having Altria at a very small portion of my portfolio for that dividend and for that future in MJ, I'm willing to take that risk. Same thing with AT&T, guys. And mind you, all of these stocks we're going to talk about, they're very tiny portions of my portfolio. I'm mostly in tech stocks. Honestly, guys, I'm more growth oriented, but I do like having some dividend stocks that are more safe, that do pay that passive income every quarter, every month, whenever they do pay it, right? So stock number 3, which isn't really a stock, it's actually an ETF, is DGRO iShares Trust Core Dividend Growth ETF. So I like companies that have awesome current yields, right? Kind of like AT&T and Altria, paying around 7 and 8% respectively. But I also like companies and ETFs that have a bunch of companies in them that pay growing dividends, faster growing dividends, despite that dividend maybe being smaller today, right? Because I know in the future, since the dividend is growing very quickly, in the future, the dividend is going to be larger, right? So DGRO, which is what I like to call it as a little nickname there, it's gone from $43 to $27 in the pits of the crisis. It's recovered from $27 pretty much all the way back to where it was before. Because if you guys take a look at some of these companies, and mind you, it's at $40 right now. Before the crisis, it was around $43. If you guys take a look at this ETF, all of the holdings a lot of the holdings are dividend growth companies. It owns Apple. It owns Microsoft. And it does have some higher yields in the moment type companies, kind of like Verizon, J&J, JP Morgan even. That's a bank stock that's gotten crushed. It still pays a pretty decent dividend. Procter & Gamble, Pfizer, Chevron, Home Depot, Coca-Cola. So it has some dividend growth there, but it also has some current dividend yield companies that pay more now that aren't really growing as much as, let's say, the tech stocks. And for me, I like DGRO here because it's an ETF. It gives me more exposure to different sectors, different industries. If you guys take a look here at what this is split into, if we go down to portfolio, we can see 20%, 18% actually is in IT, information technology, 18% is also in financials, 16% here in healthcare, 12% in industrials, 11% in consumer staples. So this is a way to get diversity, right? And just one tradable ETF. And when it comes down to the dividend yield, what you actually have to pay for a fee for this ETF, the dividend yield in this ETF is roughly 2.5%. So it's much less than AT&T and Altria, but remember, it's growing faster than those companies, right? And the fee for this ETF, because it's managed by somebody else, so you have to pay somebody else to manage these holdings, the fee is 0.08%. So very minuscule, right? A lot of these mutual funds, they make you pay 1-2% for them managing your fund. Well, this is only 0.8%. To put that into perspective, that's only $8. Am I even doing this correctly? Let me think. That's actually $8 for $1,000, right? That's $8 for $1,000, or maybe it's $8 for $10,000. you're paying in fees, which is unbelievable, right? Let me do that math very quickly to double check. Hey Siri, what is 0.08% of 10,000? So yeah, it's 10,000 bucks. Let's say you have 10,000 bucks in DGRO. You're only paying $8 in fees. $8. So it's really nothing for that 10,000 bucks that let's say hypothetically you put into DGRO. So those are the three that I'm buying literally right now, and I own these, right? And if you guys want to check out my M1 Finance portfolio, which I own these stocks and the one ETF in, check it out down below in the description box. That's actually a portfolio I built strictly for the YouTube channel that I built from $0 back in July of 2019 all the way to where it is right now. So go check that out down below in the description box. And now let's get into that one bonus one that is pretty risky, but it could end up panning out. And the very risky one here that I'm watching, and keyword there, watching, this is actually one that I'm not buying. The first three I am buying, but this one is a bit risky for me, so I'm only watching it right now, is Exxon, ticker symbol XOM. And this is obviously an energy company, right? And you guys know out there, for the most part, energy stocks and financials have been crushed a lot during this crisis, and they haven't even recovered yet. And quite honestly, it's looking like they're going to test the lows from back in March. XOM went from 71 bucks to 30 bucks. It rallied up to 55 bucks. So a pretty nice rally there, almost a double up in share price, but it hit 55 back in the beginning of June, and it's been downhill since then. Now it broke the big support at $40 to $41, and it's trending at $36 per share. So right now, oil is very tricky. There's an oil war out there. We have shale companies here in the U.S. not being able to operate when oil's low. We have oil being very volatile. And if you're looking to invest in an oil company, an energy company like Exxon, you really have to bet on the future correcting. And by that, I mean you're really just betting on oil prices going higher. You're betting on a lot of the demand with airlines, cruise ships. A lot of the demand is going to come back and even exceed where we were before, because you guys have to realize when this crisis hit, a lot of these, there was an oil glut, right? A lot of these companies that use a lot of oil, airlines, cruise ships, they were shut down. People weren't flying. People weren't going out. And they weren't even driving their cars, which also use, for the most part, unless you have a Tesla, which I don't, right? But for the most part, a lot of cars use fuel, oil. So a lot of these companies were getting hit. And on top of that, the price of oil got hit. If you guys remember, I think it was the May contract that went negative. So the oil market, energy got completely crushed. And at this point in time, a lot of these dividends are at risk, which is why I'm saying this company is very risky, despite it being a traditional long-term blue chip, whatever you want to call it. But at this point, it's kind of falling out of that blue chip status, in my opinion. And it pays a 9.4% dividend, roughly a 10% yield, which is very high. But again, it's risky. This could get cut. For all we know, oil, energy companies, they can cut their dividends completely. We've seen it done in some of the other companies out there. So that's it for this video, guys. Be careful with XOM. This is one, again, that I'm watching. I'm not actually buying it right now, but the other three, AT&T, Altria, and the Dividend Growth ETF, ticker symbol DGRO, I'm buying those pretty much bi-weekly every month. I'm just dollar cost averaging in. So that's it for the video. If you guys found value, hit that like button for me. Consider subscribing to the channel. Don't forget to join our Discord chat, our Facebook group. Get your free stock from Webull, valued up to $1,600. All you have to do is deposit $100 into the account. That is how you get the free stock. And also follow me on Instagram. If you want updates every single day, you want to learn a little bit more about me, look into my life, at StockSurfS is my Instagram handle. Go follow me there. And yeah, that's it for the video, guys. Have a great rest of your weekend. I'll catch you all in the next one. Thanks for watching as always. Stay safe out there, guys. Peace out.